In 2022, a cryptocurrency project named Terra Luna was worth $40 billion. Its founder, Do Kwon, promised an algorithm that guaranteed 20% annual returns every single year with no risk. Thousands of engineers, venture capitalists, and financial experts looked at this and said, yes, this makes sense. Then it collapsed in just 3 days. All $40 billion vanished. The algorithm never worked, and those high profits were impossible to keep up. Deep down, almost everyone realized it was too good to be true. So why did they believe it? This is the main point of Chapter 18 from The Psychology of Money, When You'll Believe Anything. This chapter looks at something uncomfortable that most money books avoid. It isn't about math, the stock market, or clever strategies. It is about the stories we tell ourselves and why we believe them even when they are clearly wrong. Morgan's core argument is this: the more you want something to be true, the more likely you are to believe a story that says it is true. You will ignore the facts, the logic, and the warning signs because you want the reward so badly. This is called motivated reasoning. It means your brain doesn't look at facts clearly. Instead, it looks for the answer you want to be true. Then, it works backward to find reasons to support that answer while ignoring any proof that says you're wrong. Morgan explains why this is so powerful with money. Money is very emotional. It is tied to your family, your dreams, and your safety. When someone tells you a story like, you can get rich quickly, easily, and safely, you want it to be true so much that your brain ignores every warning sign. This weakness creates a big problem. Many people take advantage of it. Scammers use it to trick you. Marketers and influencers use it to sell you things. And you even use it on yourself when you talk yourself into a risky bet because you really need the money. The world isn't driven by facts. It's driven by stories. And the most dangerous stories are the ones that feel so good you don't even want to ask if they are true. Let's look at our first story, Bernie Madoff, the story people needed to believe. We talked about Bernie Madoff in Chapter 3. He ran the largest Ponzi scheme in history. This chapter explains why it worked. And the answer isn't that Madoff was a genius con artist. It worked because the people he tricked wanted to believe his story. Madoff promised consistent returns of about 10% to 12% every single year. In bull markets, in bear markets, through recessions, through booms, perfectly smooth, perfectly consistent, perfectly impossible. Now, anyone with basic financial knowledge knows this is impossible. Markets are volatile. No one can generate consistent, positive returns year after year without exception. The math just doesn't work that way. And yet, some of the smartest investors in the world gave Madoff their money. Banks, hedge funds, charities. These were people who knew better, but they still fell for it. Why did they believe him? It was because they wanted it to be true. They wanted to believe that someone had finally found a way to make money without any risk. They loved the idea of guaranteed profits so much that they stopped asking difficult questions. A few experts, like Harry Marco Polos, tried to warn the SEC for years. He sent detailed reports proving that Madoff's numbers were mathematically impossible. He practically begged them to look into it. But nobody listened. It wasn't because the evidence was missing. It was because Madoff's story felt too good. It was comfortable and attractive. Nobody wanted to ruin a good thing by investigating it. When it collapsed in 2008, $65 billion disappeared. Charities were wiped out, retirement savings were destroyed, and thousands of lives were ruined. This didn't happen because people were bad at math. It happened because they fell for a good story. Let's look at our second story, the power of narrative over numbers. Morgan makes a point that I think is very important. He says that humans don't think in numbers, they think in stories. If I tell you, the stock market usually goes up by 10% each year, but it can drop by 30% or 50% at any time, your eyes might glaze over. It sounds like a boring math class. But if I tell you, my neighbor bought Apple stock 5 years ago and just paid for a huge house renovation with the profits, you are interested. You want to know more, and you might even go out and buy that same stock tomorrow. A good story is much more powerful than a bunch of facts. This is true even when the facts prove the story is wrong. You might listen to a story about one person like your neighbor and ignore 100 years of data that says something different. This is exactly how bubbles start. They don't start with spreadsheets or math. They start with stories like, My friend made 5 times their money on Bitcoin. Or, like, my coworker quit their job after selling an NFT for $500,000. Each one of these stories is just one tiny example. In the world of math, they don't mean much, but emotionally, they feel overwhelming. When you hear enough of these stories, they turn into a narrative that everyone starts to treat as the absolute truth. Now, let's see the recent story, which was so seductive that it swallowed $40 billion in just 3 days. The Terra Luna collapse. In 2021 and early 2022, a cryptocurrency project called Terra Luna became one of the most famous names in the crypto world. Terra had a stablecoin called UST. A stablecoin is supposed to always maintain a value of exactly $1. Usually, these are backed by real dollars kept in a bank, but Terra was different. It used an algorithm to keep the price at $1 by linking it to another coin called Luna. Here's the part that nobody could resist. A protocol named Anchor was built on top of Terra. It promised to pay you 20% interest every year. On the deposit money, think about that, normal banks were paying 0.5% interest, as Anchor was promising 20% interest. It was guaranteed. It sounded like the perfect investment, with no risk at all. Now, stop and think for a moment. Does a guaranteed 20% profit with no risk sound familiar? It should. It sounds exactly like Bernie Madoff's scam. It sounds like a story that is too good to be true, because it is too good to be true. But people believed it anyway. It wasn't just regular people looking to make a little extra money. Huge investment companies put hundreds of millions of dollars into it. Famous firms like Galaxy Digital, some of the smartest crypto experts in the world, all fell for the story. By April 2022, the UST coin was worth over $18 billion. Its sister coin, Luna, was worth more than $40 billion. The creator, Do Kwon, became a huge celebrity. He even made fun of people who disagreed with him by calling them poor. And the story people told themselves was seductive. Algorithmic stablecoins are the future of finance. Traditional banking is obsolete, but most people couldn't explain how algorithm worked. They told themselves, I don't fully understand it, but the smart people do, and they are all investing. In May 2022, the system broke. The UST coin crashed from $1 to 10 cents. Its sister coin, Luna, crashed from $80 to less than a penny. The algorithm that was meant to save everything actually made the crash faster. In just 3 days, $40 billion vanished. Savings accounts emptied. Retirement funds destroyed. After the crash, journalists looked back at the project. They found warning signs everywhere. Many experts had warned the public over and over again. They said the algorithm was broken and could never work. But nobody wanted to listen because the story was just too good. Morgan explains the psychology behind this, and it comes down to 3 mechanisms that our brain uses to protect comfortable beliefs. First, confirmation bias. Once you believe a story, your brain actively seeks out information that confirms it and filters out information that contradicts it. Second, the illusion of understanding. When things are going well, people believe they understand why things are well. The algorithm works because of X mechanism. The economy is strong because of Y policy. My investments are growing because of my Z strategy. Third, the social proof loop. When enough people believe a story, the story becomes true, not because evidence supports it, but because consensus supports it. Everyone is investing in this, so it must be legitimate. All these smart people can't be wrong. I want to share something I'm not proud of, because I think honesty here is more valuable than pretending I've always been rational. I have believed stories before. Looking back, these financial stories were clearly too good to be true. I once put my money into a project because a friend I trust and respect told me it was guaranteed. He was very excited, spoke well, and showed me charts where the price only went up. I didn't do my own research. I didn't check the math or look for warning signs. The story was just too comfortable to doubt. I lost money. Luckily, it wasn't all my savings, but it was enough to teach me a lesson I will never forget. Since then, I have followed one rule that has saved me more money than any other strategy. The more a money opportunity excites me, the more I doubt it. Feeling excited is actually a warning sign. It doesn't mean the investment is always bad, but it means I need to look at it very carefully. Now, when someone tells me about a perfect opportunity, My first reaction isn't to ask, how do I join? Instead, I ask, what could go wrong? If they can't give me a clear answer, or if they get angry that I even asked, I know I'm looking at a story, not a real investment. The question, what could go wrong, is the best way to stop yourself from believing a dangerous lie. There are 3 takeaways from this chapter. First, if a money opportunity makes you feel a rush of excitement and dreams of wealth, stop immediately. Excitement shuts down your ability to think clearly. This is exactly what scammers and bubbles use to trick people. When you feel that thrill, just pause, research, wait, and get a second opinion. If the idea is actually good, it will still look good after you calm down. Second, before you invest, search for people who think it is a bad idea. Read their arguments and understand why they are worried. If you can't find anyone who disagrees with the investment, that doesn't mean it's perfect. It means you are only hearing one side of the story. The absence of criticism is the most dangerous red flag of all. Third, if you can't explain how an investment makes money in simple words to a 10-year-old, you don't really understand it. Investing in things you don't understand isn't smart. It's just gambling on a story you can't prove. If an explanation uses confusing money talk or asks you to just trust me, walk away. That's chapter 18, When You'll Believe Anything. The chapter that exposes the storytelling machine inside your own head. The one that makes fiction feel like fact when enough money is on the line. In the next video, we cover chapter 19, All Together Now. This is where Morgan pulls everything together. Every lesson distilled into a unified philosophy of money that you can actually use. Like this video if it made you question a belief you've been holding without evidence. Subscribe and tell me in the comments, what's a financial story you once believed that turned out to be completely false? Your answer might save someone else from making the same mistake. See you in the next one.